We have a great episode today. I thought I'll call it the Great VC Reset, Venture Capital Reset. But then I realized that there isn't going to be a great VC reset, because anytime someone says there is some great X reset happening, the great thing never happens. So I thought I'm going to name it the small VC reset. Because let's take the reset that we can get. Why do I call it the small VC reset? Because for roughly the last 24 months, the default way in which we were exposed to venture capital and its effects has been in many ways paused. There's a slowdown. Venture capital funding for the first 9 months of this year is down 7% over the similar period last year per Tracxn. We've all read various news articles about layoffs happening in various companies being shut down, downrounds being happening. From a time where unicorns were being born every 3 months or so, now where unicorns are kind of dying and they're going extinct. Capital is abundant. There's a lot of dry powder uninvested everywhere, but it's just not getting invested at the same rate. Building a company and scaling a company is getting cheaper because of ChatGPT or LLMs, right? Which can generate code, which can generate images, which can generate anything that you want. And surprise, surprise, there's focus on profits now. Most companies and startups and founders are now focusing on profits. And for the first time in what seems like a lot of time, we don't seem to be having a lot of venture capitalists out there giving advice on what startups seem to be doing. In many ways, I call this some kind of a pause or an interregnum in what venture capital was doing. On that note, I'm really thrilled to invite two of our guests today. Manav Garg of Together Fund. I'll welcome Manav firstly to the show.
Thanks, Rohin. Thanks for
I've
having
had
me.
you earlier on First Principles. It's lovely to have you back again for 2x2.
Yeah, I enjoyed the conversation last time and looking forward to the conversation today as well.
I hope you'll enjoy today's conversation as well. I know for a fact I am definitely looking forward to. Brief introduction on Manav. Manav started and ran Eka Software for 20 years and he sold it in 2024. And then he started a fund, co-founded a fund called Together Fund in 2021, whose first fund was $85 million.
That's right.
And then you raised Fund 2 in 2023, which was $150 million. My second guest today, Rajiv Srivatsa. And welcome, Rajiv, to the show.
Thank you. Thanks for having me, Rohan. Great to talk to you.
It's a pleasure having you. Let me introduce Rajiv as well. Rajiv is the co-founder of Urban Ladder, which in many ways was one of the pioneers, or probably the pioneer, of online furniture retailing and home furnishings in India. Rajiv and Urban Ladder raised a total of $105 million, if I'm not mistaken. Rajiv, you quit Urban Ladder in 2019, and Urban Ladder itself was acquired by Reliance in 2020. And 2020, you joined Antler to head its India operation. You want to tell us about Antler?
Antler was a very decentralized setup of local funds with local teams taking decisions locally, and sort of the platform itself connecting to help in capital and help in fundraising and help in sort of go to market, right? That was sort of the vision for Antler. So very decentralized Y Combinator, but going one stage earlier, which is, can I go when the individual is not even quit their job yet, right? So that was sort of the vision. Started officially in 2018 with a fund in Singapore. It was a small fund, 20 million or so.
So before I move on to my co-host Praveen, I just want to mention the similarities between what the both of you do, Rajiv and Manav. Both of you are ex-founders who are now VCs. And interestingly, before coming to the recording, I was looking at both of your websites, and many of the things that Together Fund says and Antler says are remarkably similar. Again, like you said, Manav, it wasn't planned, right? This wasn't planned, right? Both of you talk about being founders first. Literally, the first value on both of your websites is we are founders first, right? Both of you say something similar, that we are early believers, we are day zeros, yeah? You talk about going beyond capital, having 100% ownership, open ecosystem, community. So there's a remarkable similarity between the two of you. But I think what's most interesting for me is on the 2x2 podcast, listeners will notice typically I'm the VC baiter or venture capital baiter across most episodes. And I've been wanting to do an episode on how should we think about resetting VC for a while. And therefore, what a better opportunity than to get two former ex-founders who are now VCs, but also not traditional VCs, right? You're not just joined a large, an Axel or like an A16Z or a Sequoia or whatever it's called right now. One of the peaks, right? Peak 15.
Peak
Everybody is like a peak these days. Sorry, side rant, right? So, but yeah, we'll get back to that. Before that, let me introduce my co-host, the one and only Praveen Gopalkrishnan.
Thank you, Rohin. I just want to say that for both of you, I've heard Manav's episode on first principles. It's been fantastic. Rajiv, of course, I mean, Antler, as amazing as it is, quite frankly, I think Urban Ladder is one of those brands that still stands for such a long time, especially in Bangalore. And so thank you both for being here. I'm going to start with a very simple question. Why are VCs so optimistic all the time? And look at us, there are two career journalists sitting over here, and you're all very accomplished people, and you've all done some wonderful things. So let me now ask this question. How is it that the world is so positive and so amazing and so optimistic all the time? In some ways, I understand the business requires you to be that. But I think that the first question, that the thing that has changed, and Rohin spoke about the great VC reset, and I'll talk about one thing that I've started to see that has changed a little, which is suddenly, slowly, some VCs have slowly started to act a little bit like journalists. And they've started to say things like, there is some limits here, there are some weird things here that's happening, let's not get carried away, let's not go overboard. I'll give an example. There's this analyst from Sequoia, we spoke about Sequoia, this is Sequoia US, so it's not the peak 16 over here, and he wrote an article published around 6 months back called AI's $600 billion question. And I'm going to read this trap. I don't want to go into the details, but it says the AI bubble. I don't know when this is the last time a VC wrote this phrase. And the AI bubble is reaching a tipping point. Navigating what comes next will be essential. So essentially what he's saying is in this article that this thing is getting too big. There is no revenue. The costs are going crazy. Let's really talk about what's going on here, which generally does not happen. So I'm going to ask both of you, have you noticed this recently? Have you seen certain amount of the optimism that all VCs have kind of diminishing a little?
See, I'll give you a small story. I was a trader before I came into the software world.
Okay.
I used to trade in green coffee trading.
Green coffee?
Yeah, the coffee that we drink.
Yes.
Unroasted.
Yeah, unroasted.
Yeah.
Green coffee is unroasted coffee, grown in Vietnam, Colombia, Brazil.
Got it.
And India also grows some, but and we all consume that on a daily basis. It's very popular in India now, right? So when you trade, we used to trade for longer term, like next year how the crop will be. Knowing very well there will be a frost in Brazil, there could be rainfall in India, rainfall in this thing. We don't know what's going to happen. We will take a position 12 months ahead of the line. And a lot of variables are there. So the root cause of the optimism is basically you have to believe in, we'll all live in hope. When the variables are too long and too large, the optimism helps you ride through the daily troubles that are going to hit you. So VC, to my mind, coming from an operator point, is essentially a process of creating something by taking a unnecessarily large risk, knowingly very well that you may miss most of the things that you're going to invest in. So that can only survive on a day-to-day basis. I feel only happy when I'm inherently an optimist, right? It's the same way a founder also thinks, right?
Thank you for making that this thing, because I was going to disagree with you and say, you know what? Who the real optimists are? The real optimists are the founders.
Yeah.
And while the two of these gentlemen right now here are wearing their VC hats, they're both ex-founders and also current founders.
Yes.
right? Like Rajiv said, he founded Antler, and like Manav said, he co-founded Together Fund, right? So the optimism that you talk about, so I mean, I'd beg to differ. As the professional VC skeptic on this show, VCs are not optimists. VCs invest in founders. Founders are optimists. But I want to bring you, all of you folks, into what I feel the great reset and why are we discussing venture capital here. And there are a bunch of points that I made, right? Like, and I find, and loosely, what's wrong or what's broken with the traditional venture capital model. Now, venture capital is a very complex asset class. It spans, I mean, it's existed for like, decades. It spans really large funds to small funds, etc., and stuff like that. So at the risk of generalizing, but I'm going to generalize for traditional venture capital, right? And there are things that we romanticize it for. Firstly, there is this thing called go big or go home, right? Which is aim for the stars, right? Aim for that 100x exit that will generate the returns for the fund, and either you make it or you die. So another version of calling it is like bet the house on something or grow or die, which actually has created outsized outcomes, like for example a Swiggy or a Zomato, but which also created lots and lots of dead companies, fired employees, and destroyed Scotch sectors, etc.
And a lot of bad behavior.
And a lot of bad behavior. Great. So I'm just getting started. This was my point one.
Oh, okay, sure. Let's go.
So, Rajiv, we discussed before. Both of you are also dads. Praveen, you're not a dad. The three of us are dads, right? So I'm going to use a kid analogy here. The first few years, like when you're raising a kid, like the first 5, 6, 7, 6 to 8 years are kind of very foundational to how they develop as an adult, right? And if you look at a startup in the same way, that a startup is essentially nothing but a company, and hopefully you hope that they all grow up and become sustainable and profitable and live for a really long time. The first 6 to 8 years is when startups should actually build a very foundational model, but traditional venture capital typically has a 6 to 8 year return model where they need to return money to their LPs. So therefore the pressure to push kids to scale up and do things which is unsustainable. So ideally the time when young companies need to be focused on building for the long run also coincides with the venture capital urge to go big or go home, which leads to a lot of companies whose potential is wasted. 3, most venture capital companies, again, gentlemen, I'm not generalizing to your venture capital, I'm pointing about like, generic venture capital firms, right? The venture capital model is predicated on exits a lot. And the 3 most common types of exits are a public exit, just like Swiggy had today, or you sell your company, right? Which was in some senses the Urban Ladder or even Eka, right? You sold it. Or the third one is you go bankrupt and you shut down, right? In the traditional venture capital model, at least in the way it's normally discussed, there is no fourth alternative where you didn't do any of these and you survived and you're profitable and you're growing year after year. In fact, the traditional venture capital model derides those as hobby businesses. I'm sure, Manav, for many years, Eka would have been seen as a hobby business, right? Because you're making money.
I believe the term now is lifestyle business.
Lifestyle business, hobby business, right? But of course, like, you scaled it and you sold it, right? Once again, this thing of these are the 3 options, and if not those 3 options, there's also this bias towards raising really large funds. Why? Because of the 2 and 20 model, where from the outside, people think that VCs make money when they generate exits and take a profit out of it. But there's also this management fee that most VCs charge for running a fund, which is a percentage of the fund that they raise. So the larger fund that you raise, the more money you have, for salaries, for hiring people, fancy offices, etc., and stuff like that. In the last couple of years, there's been pushback from LPs to reduce the management fee, because LPs are also saying, wait a minute, if you're not investing and you're just sitting on it, why the hell are you raising these large funds, right? I mean, what Praveen said, this scorched earth model where I will burn money in order to reduce competition and leave it to be a game of last person standing. Now, it works for some. it doesn't work for a bunch of other companies, right? But the costs are typically borne by employees, stakeholders, customers, and increasingly we live in an age of platforms. So there's delivery partners, etc., and stuff like that. All of these are what I would call as the ills of an unchecked venture capital behavior over the last, I mean, if you look at India, maybe we can say like, 15, 20 years or so, maybe 15 years, right? And it doesn't get critiqued as much because when the times are great, who wants to talk about, hey, we are talking about valuations, next round, secondaries, etc. And when the times are bad, strategically, you'll find that all VCs have disappeared. Nobody's giving gyan, right? Reminds us, of such behavior. But we don't want to be that. We want to say, hey, wait a minute. We are going through this reset period where things have slowed down, right? We are going through a lot of pain right now. Let's not just paper over it. And when things improve, now everyone is thinking, hey, you know what? Trump's coming. Markets are going to be back great. There's going to be deregulation. It's going to be hunky-dory times again. I don't want us to forget where we are right now. I think these are things that we should be talking about. And I want to kind of end this section by perhaps the most egregious of incidents that I see. In 2019, I think Economic Times and a bunch of other publications also give out these venture capital awards. I mean, one of them is called the Midas Touch Award, right? Which is the golden touch, like whatever you touch turned into gold, right? The 2019 Midas Touch Award was given, one of the people who won that was Bejul Somaya of Lightspeed. Why did he win it? Because they made an exit of $1 billion. How? Because Oyo gave them an exit of $1 billion. How did Oyo give them an exit of $1 billion? Because Oyo hadn't got public. By the way, I must disclose that Ritesh Agarwal, the Oyo founder, is partly an investor in the Ken via his investment vehicle, but that shouldn't stop me from saying what I have to say. Which is, how did Lightspeed get an exit if Oyo didn't go public? Oyo didn't get sold, right? It's a wonderful question because there are only these three exit models, right? Either you go public, either you get sold, or you go bankrupt. Well, Oyo didn't do any of those. So how did Lightspeed make $1 billion? What happened is Oyo went through a lot of trouble. It is still in a lot of trouble, right? It has had to defer its IPO. It's still not gone public, right?
It's also business media behavior, but we'll cross that separately.
Well, I mean,
separate episode.
You could refuse to take an award, right?
Fine.
But if you take the award, if you put it on your website, if you put it everywhere else, you can't just blame the business
with these two
media.
gentlemen in the room, I'm not going to sit and pretend that business media is extremely great as well. So that I have to just say that.
So now, I know this has been sort of like a rant. It's been a long time in the coming. Literally every episode of 2x2 has me saying VCs. Right? So this was all of that coming on. But I'll start with you, Manav. When we were talking earlier, you did say we need to think differently about venture capital as well. A lot of the behavior that has been built up in the system, especially in the context of people who are considering joining venture capital as early employees itself, even they need to think about things differently. I'm not asking you to comment on the points that I made. You're welcome to though. But how would you think about venture capital and how it should change from where we are right now?
Yeah. So first of all, I will just give a little bit background to the context that you built upon the venture capital. So to my mind, there's nothing called traditional venture capital or a new venture capital. Venture capital is a financial asset class. Like in olden days, I come from Baniya's family. So my grandfather used to go to bank, borrow, and they run the business, and they ran the business cash flow, and that's how the business was built. In the modern age now, where I think people like me, I don't know about Rajiv or others who are coming from middle class background, this asset class give me an opportunity or window where somebody is taking an unprecedented risk on me as a young or even an old founder, and therefore I have opportunity to either make something out of it so that my family life, my families, I can contribute to society and create jobs. So therefore I see it as a very, very accretive asset class. So in 2006-07 is when most of the funds, at least to my knowledge, started coming to India. Nexus, I met Naren Gupta, who started Nexus, and they invested eventually. I met him in 2006. They came to India around that point in time. Then, Axel came, Sequoia bought, Westbridge at that point in time. So that was, I would call, the real formation of a institutional venture capital in India, right? Where big brands came, and some of the, Nexus started their own brand, and then Bloom and Stellaris came, and then many more came forward, right? So because I believe they started investing in the founders who they think they can take big risk on. The founders like me who have had no background in running a business, no money, no understanding of what's going to happen, and no history of building a global company, right? So they took unprecedented risk. So therefore, I'm very thankful to that set of venture capitalists who took that risk on those founders, right? Because I essentially believe that founders is the one who either make or break the business. It is not venture capitalists. Yes, venture capital being a large shareholder and capital will have a lot of say, and sometimes they may pressurize founder to go in a particular direction. But it is founder's ability to handle that pressure which actually in the end counts. So therefore, what I believe is I call it venture capital 1.0, which I would call from 2006 to till 2021, which was the peak that we saw for almost a decade and a half in India, where we have institutional capital came in, they bet big on businesses. Some businesses like Freshwork become massive success. Flipkart become a massive success in terms of outcome. Some of them have bad examples like Baiju's and few others.
And the entire edtech sector
in a way. So a lot of sectors went wrong. But that's what happens in an early stage of any formation of anything. It's like Manthan, right? You have to first, poison will come out, good things will also come out with it, right? So, but that's what it is, because that's how the world view sees it, right? And there are equal amount of issues that happen in the Western, which is a very developed market, where FTX happened in parallel. When Baiju was happening here, FTX was happening
Sure,
there.
we agree.
So what I see was VC 1.0, where good people jumped in, they backed the founders, and founders also very new. So they are very early learning in almost all the sectors. B2C sector, the customer acquisition was an issue. I still remember nobody believed in e-commerce in 2008-9. Who would have thought that they were equal amount of, their room was always fully split. E-commerce is going to lose money, there is no value creation, but today here we have a very robust e-commerce sector, including quick commerce now, right? And then Swiggy and Zomato including to that. So we went to a VC 1.0 wave where we have made mistakes of governance, of understanding which sectors can make money, of not being very profitable and money flow into India. Now we have consolidated most of the learnings to large extent, and there are new players have come in. A lot of founders are turning VC, which is what
So
Rajiv and I.
what marked the end of was, when you say VC 1.0, can we agree that what marked the end of VC 1.0 was the end of the zero income rate phenomena era?
Yeah, because it fueled
Easy money.
Yeah,
Easy
it
money.
fueled
So, all
hedonist growth. Everybody thought I am a star because only way things will go is up. Even stock market, you
Right.
invest in one stock, every day it's going up. You think I am the most intelligent person in the room. I can never make a mistake. And that's what human behavior is. All of us think the same way, that things are never going to go wrong.
I'm not saying there were no good bets. I want to keep the conversation focused on, in all of this, there was so much of herd mentality and pushing founders to just burn money to win market share and do unsustainable things, which is kind of seen as the cost of doing business, that it's a normal way. Yes, of course, if you're raising money and if you're not burning it, I mean, if you remember, right, like, the entire...
I understand what you're saying.
Yeah.
So I think good and bad always comes together, first of all. So good part is somebody took an unprecedented risk. Some companies really got formed. And bad part is, governance got out of window because money was coming cheap and very fast. Some people were, for the first time coming into venture capital system, they thought just by putting more money, I can get better returns. And they were getting also because mark to market was going up. So that was excesses of that era. But that always come hand in hand. The question is, as an ecosystem, what have we learned from that?
What is it?
Number one is the governance. For example, if you look at today, and this is my famous line to all the founders, how many VCs are able to have a heart-to-heart, honest conversation with the founder if things are going wrong? Because the issue, the whole venture capital model works is, I invest in Rohan. Rohan will give me positive reference. Then he will talk to Praveen. Then Praveen will take my money because he's talking positive about me, right? You're not telling him the actual things. You're talking positive things about me because I'm going to compete in getting into Praveen's company tomorrow. So therefore, whole things that's how the vicious circle starts. So in that case, I will never be able to tell the truth on your face. I'll never say, Rohan, this is what you're doing is not right as per my opinion. Let's look at some data. And if you don't do it, we won't see the light of the day as a company.
And to be fair to VCs, I never thought the day would come and I'd say that. It was also the era of founders where founders had multiple term sheets and founders could play VCs off against the others, saying, if you're not going to kowtow to me and like let me do what I want, I'll just take money from someone else. And I mean, we're honestly discussing the era where SoftBank apparently famously said that I'll just, if you don't take my money, I'll just give it to the number 2 company in your sector. So therefore, I commiserate with that.
What I'm saying is somebody has to talk about truthfully with empathy to the founder first of all. Because eventually you're backing the founder.
But there was no incentive earlier to do that.
No, the business model was like that. If I don't get a reference from you, then next time for me to build my business as a VC is extremely hard.
There is a very famous saying which all of you will know, which is lemons mature faster in the VC industry, right? What it essentially means is if you've invested in 10 companies, you should figure out very quickly which are the ones which are not going to succeed, and they will mature faster, so you can switch off from them. So the point that I'm trying to make is that if you're a traditional VC, even though we may disagree on the notion traditional VC, and if you've got 10 companies and 2 of them are growing like gangbusters, right? Even their losses are growing, but their valuations are going, you're focusing on them. Now, 2 of them are fully dead. Maybe 6 of them are in a place where they require help, they require bandwidth, they require mentoring and attention. Why is a VC incentivized to spend time on them? Because the traditional VC model incentivizes aiming for those 2 outsized hits and spending more money, more time on them. Right? So I will argue that the reason why you folks are saying that you want to help founders is because personally and professionally you're aligned towards that model.
Actually, it's a slightly different philosophical take here, which is you're in the financial asset class. You're in the finance asset class. Every VC wants to add value, right? Together.
Wait,
and
no, I'm not letting that go unchallenged.
So, no. And this is sort of a justification, right? You
value
think that
means what sense? Financial value?
And that's the thing, right? Which I want to come to. Let me rephrase. Every VC actually does not want to add value, but how do you differentiate means you have to start providing value. When you're at the early phase, which is what, let's say, Together does or Antler does, you have to do certain things beyond just providing capital. Because at that very early stage, there are 10 reasons why you will fail, and even one help somewhere might be the difference between success, existence, and death, right? As you mature, all the way to, finance comes all the way to your IPO, right? The later the stage, you really become a check writer, right? And
yeah,
there
the
are
last
2
stage
reasons.
is like private equity. So it's
Like
fundamentally
private equity and later stage venture capital. Somewhere you have to understand, of course, you'll help and you'll open doors. But I think A16Z probably challenged this, in 2008 when they started, that they became, came with this full service model, and then Sequoia also sort of adopted that, and a bunch of other VCs did that. Now, obviously, you have to differentiate within their own asset class, and people have to do certain things. But you have to understand that as the founder, and we'll take the split of the 2, 6 and 2 that you said, some of the founders who are doing really well have great teams. The moment you're $100 million, $200 million, no operating person there who's smart enough wants any gyan or help from a VC. Let's be clear. Okay? No person they will come to you when they want help. That is usually access or some more capital or whatever else, right? No VC wants to interrupt and intrude into the way of working of a founder or a company, right? They really want to be, outside support, as well as sort of do the governance as part of the board and connect where the founder needs them. And also, let's say position for the next round capital and stuff, right? That's really the job. Now, if, as you said, 2 die, it's hard to do anything there. Maybe you do a bridge, whatever else, but you can't do much to take off. And then there is these 6, let's not call them limbo, but let's say they're sort of middling, right? Now, the challenge in that is they probably have some talent, and there are 2, 3 kinds of challenges that can happen. Market didn't take off compared to what everyone imagined. Product market fit was achieved at a particular scale. It didn't take off at the next scale. There are some people or founder or some issues with respect to people, right? In the case of 1 or 2, the VC is really not equipped to sort of really help the founder, right? Maybe some more capital, maybe it can't. And you can have thesis, and that's what you discuss. You can have more discussions, but really the founder and the team are supposed to. If it is a people and especially founder level challenges, really the VC or the bunch of VCs who are on the cap table have to intrude, right? Because clearly something is going wrong. So the VC's ability and or the charter to help really is in bucket 3, not in the bucket. So out of the 6 also, if you split, it'll be 2-2 probably, right? And the good VCs there come and help. Even they try to come and help in the 1 and 2 also, but they're not equipped to help, right? Because they're not the experts and they have no clue what the customer there wants and stuff, right? So that is really the thing, right? So good VCs and the VCs who have built a brand over 50, 60 years and are still fledgling are the ones who have done that really well, right? Otherwise, and the ones who have not done that are the ones who have probably not been able to do that well. And that's at least my take.
Yeah. Can I want to ask this question to both of you, right? Like this entire focus of pumping founders and saying, growth or die or go big or go home should the sustainability now, because the end of the ZERP era, sustainability and profits has entered the lexicon. But as new VCs, are you now saying when companies start, are you saying that think about sustainability and profitability right from get-go?
I think it is founders' prerogative first of all. So as a VC, we are not mandating you become profitable today because founder is the one who's building.
No, sustainable. At some point, is
So
sustainability.
I'm coming to the conflict of point where it comes, right? Let's say you're running a B2C company, D2C brand. Tomorrow
Right.
you say, I'll become 100 crores. You become 100 crores and you say, I am very bullish now. I'll become 300 crores the next year. And you burn now 100 crores, but 300 crores doesn't happen. You're only at 150 crores for
Got
whatever
it.
reason, right? Now you burn the capital. Now that is where the point of conflict may arise because you need more capital to sustain the company, and VC is saying you are not performed, right? So an honest conversation, typically in a family business, let's say all of us running business, you will have honest conversation with your brother, sister, or whosoever, father, saying, I made the mistake. Please give me more capital so I can sustain a bit more, right? So I think I'm talking about going through that eyes and ups and low for sustainability. Coming to your point of profitability, that is linked to a cost of capital. See, let's not confuse that cost of capital and profitability are very interlinked. In year 2019 to 2021, when the interest is zero, as a founder, I will take as much capital as I want and try to grow. I may fail. I'm anyway, incentivized to fail, or I will take larger risks. So I took larger risk. In some cases, it pan out. So I don't think, therefore, profitability was an issue because growth capital was free, literally free. So it's okay to be not profitable, man, because even if I'm profitable, I'm not earning anything on that. So I would rather reinvest everything or larger capital. Enter the era of very high interest rate, which we are in right now, which eventually will come down. Then now I have to balance growth and profitability. So I think that is linked to the interest rate cycle. That is not linked to as much about, grow home. That is again, some part of VCs may have mistake. They're saying putting a lot of pressure, grow fast, valuation will increase, my mark to market will increase. That I think VCs have understood that, and LPs have also understood that game, right? So there's a lot of discussion also happening on VC governance by them. How do you mark to market a company? When do you mark down a company, right? So, for example, if you were invested in a Baidu or an Oyo, when will you actually mark down? So your book was at $6 billion book value, but actually, the value is only 3 billion or 2 billion. Then at what point in time you're going to mark your value down? So, a lot of governance coming within the VC ecosystems also, VC structures as well. So there's also that part of the business which is getting to maturity stage. I think so. Therefore, I all take it as maturity as long as we can learn from it. I think that my biggest point, I keep on coming back, are the learnings well entrenched, which is governance and honest conversation, because it'll go out of window very fast when the money again becomes cheap.
Absolutely. What you just listened to were just some of the highlights from an almost 90-minute discussion that Praveen and I had. If you'd like to listen to everything we talked about, you can do it either with a premium subscription to the Ken and then downloading our app, or by subscribing to 2x2 Premium on Apple Podcasts. Of course, you could also wait 4 weeks because we do usually make full episodes available for a while after that. Whatever you choose, we're just glad to have you as a listener. And if you enjoyed listening to this episode, or have some thoughts that you'd like to share with us, you can always write to us at 2x2@theken.com. We'll be back next week with a new episode for you.